We're covering surplus lines and residual markets for the property and casualty exam, focusing on how the system provides coverage for hard-to-place risks. It all starts with understanding the difference between two types of insurers, admitted and non-admitted. Admitted insurers are licensed by the state and must comply with state regulations on rates and forms. The major exam point is that admitted carriers are backed by the state's guarantee fund, which pays claims if the insurer becomes insolvent. Non-admitted insurers are not licensed in the state and are not backed by this guarantee fund, which is a critical distinction tested on the exam. They have more freedom in their pricing and coverage forms, allowing them to insure unique or high-risk exposures that admitted carriers avoid. This market for non-admitted insurance is called surplus lines. A common exam trap is thinking you can use surplus lines just to find a cheaper premium. That's incorrect. You can only turn to the surplus lines market after being denied coverage in the admitted market. This process is called a diligent search. An agent must first try and fail to get coverage from a certain number of admitted insurers, often 3, before placing the risk with a surplus lines carrier through a specially licensed surplus lines broker. For example, a new commercial building with a radical design might be rejected by standard insurers due to unknown risks. After documenting these rejections, a surplus lines broker can access a non-admitted carrier that specializes in unique architectural risks. Now, what happens when a risk is so high that even the surplus lines market won't cover it? That's where residual markets come in. These are last resort, state-mandated programs designed to provide essential insurance to those who can't get it anywhere else. The two main types you'll see on the exam are assigned risk plans for auto insurance and FAIR plans for property insurance. An assigned risk plan is for drivers who are considered too high risk for the voluntary market, perhaps due to multiple DUIs or accidents. The state assigns these drivers to licensed insurers, who must then provide coverage. Insurers participate in proportion to their share of the auto insurance market in that state. FAIR plans, which stand for Fair Access to Insurance Requirements, do the same for property insurance. They offer basic property coverage to owners of high-risk properties who have been denied coverage, often due to location, like a home in a wildfire zone or a high-crime area. Here's a phrase to remember the hierarchy. First you try, then you're denied. Then to surplus lines you've applied. This helps to lock in the diligent search requirement. The exam will try to confuse you by mixing up surplus lines and residual markets. Remember that surplus lines are still part of the private, voluntary market, while residual markets are a state-mandated, involuntary last resort. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.